It's not just the national coffers in Greece that have been running dry this year. The country's commercial banks have also seen deposits dwindle away. Well, with me now to discuss how damaging that is for Greece is Gabriel Stein, director of Lombard Street Research. Gabriel, thank you so much for joining us today. How worried are you about Greek banks, despite the assurance we've had from both the European Union and the IMF that they're ready to step in?
Well, the European Union has said it's ready to step in, provided the Greeks asks them to do so, and they haven't done so yet. What's worrying for Greek banks is that they are, if I'm not altogether wrong, the EU and above all euro area banks most dependent on short-term borrowing in interbank markets and so on. And of course what's happening now, if deposits are indeed decreasing at the pace we've seen, about 5% in the first 2 months of the year, that dependence rises. And so the costs for the banks rise, and that erodes their profits, of course. More importantly, it seems to me that what Greek households and companies are engaged in is classical pre-devaluation behavior. You pay off your imports before your currency devalues. You take out money and you hold it in something that's going to be more valuable after a devaluation. In this case, apparently high denomination euro area notes, presumably notes that are not Greek euro area notes.
Gabriel, I also wanted just to bring you some breaking news. We're hearing now as each country in the European Union tries to actually say how much they can contribute to Greece, Slovenia contributing around $196 million to the Greek loan. But how does this affect Greek banks? Do we have to see some kind of government legislation that forces people to keep deposit in Greek banks, for example, from Greek companies?
You can't do that. How can you do that? I mean, you can legislate, but you can't force people to keep money in the bank. If depositors, I mean, that essentially is stealing people's money.
Yeah.
If depositors were to withdraw their money, then either Greek banks have to borrow more, or, of course, the Greek government can replace those deposits with deposits of public sector money. But, of course, that means borrowing, and that means borrowing presumably in the central bank, which is illegal. But if necessary, they will do that, because the alternative is one side of the balance sheet shrinks, the other has to shrink as well. So they'd have to call in loans, which they're obviously not going to do.
And this is a huge issue. Are we going to see deposit in Greek banks fall even further to what we've seen in the last couple of months?
If we do, I can't say we will, we won't, we'll see. But if we do, and if this pattern continues, I think the process towards a Greek euro area exit becomes inexorable, becomes impossible to stop. Because it comes a stage where even Greek politicians must think that the pain that they are inflicting for what they presumably call the greater good is simply not worth it.
But Gabriel, would that not be a disaster? I mean, we're talking about fiscal consolidation without the European Union. This is a very young formation. If we were to lose a member, then that would effectively mean that there is no European Eurozone anymore.
No. It would mean that some countries would almost certainly leave the Eurozone. But you have to remember that from a German perspective, these were countries that should never have been in the Eurozone in the first place. The Maastricht criteria were invented specifically to exclude Italy. Now, they failed because everyone cheated to get in, with the exception, I think, of Luxembourg. But I thought, I must tell you, I thought until about 4 weeks ago that exactly the way you do. Greece has to be saved, because otherwise the whole idea that the euro is the path forward, the foreordained path of history, goes out the window. But recent German behavior, comments both by the finance minister and the federal chancellor that countries can be expelled and so on, leads me to believe that Germany would in fact be very happy to correct what they see as something that should never have happened and get rid of a number of countries, and then go on with a core euro area where presumably they believe the euro would be stronger and these countries would indeed form an optimum currency area, which the euro doesn't today.
All right, Gabriel, thank you so much. Very interesting analysis. Gabriel Stein there, director at Lombard Street Research.